United States Treasuries are considered to be the safest, most conservative, most liquid asset in the entire world. But a problem comes up when the institutions who are the biggest buyers flip and all start selling at the same time. And that's exactly what we are seeing right now with the Federal Reserve, foreign governments, and commercial banks stepping back from the Treasury market. We're seeing a liquidity problem emerge, causing a nightmare for the Federal Reserve. The auctions for new treasuries are experiencing extremely weak demand, and yields are increasing to levels that we have not seen in years. So is it possible that at some point soon here, the federal government goes to borrow more money and there's nobody left to lend more money to them? And if that happens, what happens next? Ready? Let's dive in. I've been seeing more and more articles and pieces written about liquidity problems in the Treasury market recently, and the frequency at which I've been seeing these has been increasing lately. On September 26th, TheStreet.com wrote about the 2-year auction and how there was weak demand. Simply explained, this means that the federal government went out there and they said, hey, we want to borrow this much money and we'd like to borrow it at this rate. Who would like to lend to us? And there were not as many lenders as they wanted, and so they had to offer a higher rate on the new debt that they were borrowing, and so there were increased costs for that new debt that they took on because there just weren't enough lenders at the lower rate. And then on October 6th, there was this article on Yahoo Finance from Bloomberg about Treasury's liquidity problem exposes the Fed to their biggest nightmare. This was specifically about it being difficult to buy and sell treasuries in large quantities because those trades move the market. There's just not enough market depth for those large trades. Now, if you're not familiar with what market depth is, it's basically all the buys and all the sells, the limit orders waiting out there to be filled. This exists with stocks, it exists with treasuries, with crypto, everything, eBay even, used iPhones. And so this is where you have all the buyers and all the sellers, and they put out there, they say, I'm willing to sell, but I want to sell at this price. And then somebody else comes in and says, I'm willing to buy, but I want to buy at this price. And they all have the quantities as well that they're willing to buy and sell at those prices. For example, if we take a look at the market depth listed on Robinhood Level 2 data, we can see that on the left-hand side of the right picture, we have a column called Bid, and then to the right of that, we have a column called Ask. And then on the far left and the far right, we see size. In this example, there are 16 shares willing to be purchased at $13.45. There's somebody else that wants to buy 30 shares at $13.41. And there's somebody who wants to buy 43,500 shares at $13.35. If we go on the right-hand side of the column, we can see about halfway down, somebody wants to sell these shares at $13.91. Below that, we see there's somebody who wants to sell 300 shares at $13.95, and then below that we see somebody wants to sell 2.2 million shares at $14. So as you might imagine, those smaller share numbers could get traded through very easily, because if somebody comes in there and they start selling a bunch of shares, they'll sell everything to the person who wants to buy 13 shares. They've got more to sell, so they'll sell some to the person who wants to buy 30 shares. And then the next place where we'll probably soak up the rest of the sell order is the person who wants to buy 40,000 shares. And this is how all markets work. You have everybody out there who wants to trade saying how many they want to buy or sell and what price they want to buy or sell it at. And then the trade will happen when two people agree. The market will move either to a lower price or to a higher price when a buyer or a seller comes in and soaks up all the liquidity and soaks up all the buy orders or the sell orders by their large order. But again, as this article points out, it's getting harder and harder to buy and sell treasuries in large quantities because those trades are moving the market. The market depth is very illiquid right now. But if we take a look at the direction that yields are going, we can see that the market is really illiquid in one direction. direction. So to me, this looks like a little bit of a misdirection from the media. It's not so much that there's illiquidity and a lack of market depth going on here. What really this looks like is that there's a lack of buyers of government debt. And there's plenty of sellers. They're just trying to sell at a pace that they're able to get as much for their bonds that they're selling as possible without tanking the market and driving up yields. So there's plenty of liquidity on the sell side. Everybody wants to sell. There's not enough buyers. And that's the key issue here. As this Bloomberg article points out, the most powerful buyers in treasuries are all belling at once. Japanese pensions, life insurance companies, foreign governments, US commercial banks, and the biggest of all, the Federal Reserve. Massive buyers historically of US Treasuries, which is another way of saying massive lender to the United States government. And right now, they're all doing the opposite. They all want to sell that debt, including the Federal Reserve. If we take a look at the Fed's balance sheet, this is something nobody believed me about for the first part of the year, and I said it over and over and over again. The balance sheet would start going down, and look at this. The balance sheet has started to head down. They've been getting rid of assets off their balance sheet, and recently the pace at which they're selling these treasuries has accelerated. So my question is, why the misdirection, number one, and why the attention on this in the first place if all you're going to do is try and misdirect it to something that's not the real issue? Because it's not an issue of liquidity, it's an issue of liquidity just on the buy side. We don't have enough buyers. So why even bring it up if you're just going to try and point the direction in another way? Well, I think it's because of this. We're seeing a lot of people recommend to find a new marginal buyer of treasuries, that regulators need to step in and fix the market structure, that we need an intermediation mechanism in order to fix the system. This could look like enhancing the role of a central clearing for treasuries. And something I've talked about in a past video, creating a new government agency that operates as a market maker in treasuries for the government, which would be just an absolute disaster. But ultimately, I think that's where this is headed. I think more and more people are going to start pushing for a new agency that will operate as a market maker or a clearinghouse for treasuries because of liquidity problems. Not because we've got the highest inflation in decades and people don't want to own low interest debt that is guaranteeing them a loss that is now becoming completely illiquid, that they can't even sell without moving the market because treasuries are not the safe haven asset that they once were. So this isn't going to happen just for no reason. There will probably be some sort of a liquidity event, probably some sort of an auction that just goes no bid and nobody is stepping in to buy that government debt, where you see a lockup and a bunch of people need to sell debt, but there's no buyers on the other side. And in this situation, we're going to have one of two choices being made. We have two outcomes. Number one, the Fed has to pivot and restart QE and do it in a way where they try and tell the world it's not actually QE, just like they did in 2019. If we were looking at their balance sheet would start to increase again because they would start to buy treasuries. But they would only do it at the extremes, and they would still allow huge price movements to happen so that they could claim they were not doing it in order to boost the economy. They were only doing it to make sure the financial system kept on operating. This would also prevent the government from defaulting because of not having the ability to borrow extra to pay off their old debt if they get that Treasury General account too low. Now, if they go this route, it will be very clearly vocalized from the Fed that they are not doing this to prop up the financial system, to prop up asset prices or anything like that. They're only doing this to make sure that there's at least some bid, even if it's at a very low price, directly from the Fed. This would mean borrowing costs for the government would still be higher, although not really, because we know that any debt that the Federal Reserve owns, those profits get swept back to the federal government. So technically, the federal government could have 100% interest rates on its debt owned by the Fed, and it doesn't cost anything for them because they get all that money back. It's like taking money from one pocket and putting it into the other pocket. Now, here's what I think will determine whether that option takes place or not. I think if inflation is still extremely high, above 6%, let's say, I think this probably will not happen. I think the Federal Reserve would still be too concerned about losing their credibility if they were to look like they were reversing course and pivoting, starting up QE again when inflation is still high. So I think if something like this happens while inflation is still high, I think they're going to go with option number 2 instead. However, I think that if inflation has come back down, let's say sub 4%, I think the Federal Reserve will be able to claim legitimacy for this pivot, for this move, and still say, hey, we're not trying to prop up asset prices or anything like that. We just need to still make sure that the Treasury market is functioning. So we're going to pivot. We're going to start buying up Treasuries again. And I think the market will buy it as long as inflation is low again, which may be one of the reasons why they're sticking so hard to tightening and raising rates right now. They're trying to get inflation lower before the inevitable pivot so that they can claim it's legitimate. That brings us to number 2. What happens then if inflation is still high and the Fed doesn't want to pivot? Well, that's where I think this new regulatory agency comes in that's being pushed, where the federal government would establish a new agency that's there to make markets and clear Treasury securities. Ultimately, this would probably be in conjunction with the Federal Reserve because the Federal Reserve and the Treasury Department are working so closely together these days. They would work together to make sure that there were no crazy things happening in the Treasury market, but they'd be able to do it in a way where it wouldn't show up on the Fed's balance sheet. Ultimately, at the end of the day, the only problem here is that there's no buyers. There's not enough people willing to lend money to the United States government. And so the only way to solve that problem is on the other end of it to have some money that's getting lent to the United States government, even if that's secret behind the scenes money that is behind the curtain that they're doing with these special purpose vehicles and hidden accounts so that it doesn't show up on the Federal Reserve's balance sheet. At the end of the day, what we are witnessing right now is the collapse of a bubble. And we've seen the biggest bubble in government debt that has existed in our nation's history unfold over the last couple of decades, and it is now starting to unravel because that's what always happens. You cannot violate the fundamental laws of economics forever and not experience the consequences. Every leveraging is followed by a deleveraging. There's no way around that. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.